On June 18, 2020, one announcement shocked the financial world. Wirecard said it could not find 1.9 billion euros that it believed was sitting in bank accounts in the Philippines. Just 1 week later, the company filed for insolvency. How can one of Europe's biggest financial companies suddenly lose 1.9 billion euros? The answer is even more shocking. The money wasn't stolen, it wasn't moved. The bank said those accounts did not exist. For years, investors believed Wirecard was one of Europe's greatest technology success stories. In reality, the company was hiding a crisis that had been growing for years. This is the story of how a company trusted by everyone became one of Europe's biggest corporate frauds. Before the collapse, Wirecard looked like the future. The company helped businesses accept digital payments. As more people started paying with cards instead of cash, Wirecard grew rapidly. Its revenue increased and its share price climbed. In September 2018, Wirecard reached an incredible milestone. It joined Germany's DAX index, replacing Commerzbank. For the first time, a young fintech company stood alongside Germany's biggest and most respected businesses. Many people believed Germany had finally created a global technology champion. Few questioned whether that success was real. The company's success seemed almost unstoppable. Banks worked with Wirecard. Major investors bought its shares. Its market value grew to more than 24 billion euros. Chief executive Markus Braun became a top business leader. Everything looked perfect. But behind the impressive numbers, serious questions had already started to appear. Some journalists and investors noticed something that didn't make sense. Each time they asked difficult questions, Wirecard had an answer. And for years, most people believed it. Success made people confident. Confidence slowly became trust. And trust made many people stop asking difficult questions. The collapse did not begin in 2020. It began years earlier, when a small German payment company started telling a story that the world desperately wanted to believe. Wirecard did not begin as a billion-euro company. In fact, when it was founded in 1999, almost nobody outside Germany had heard of it. Its business was simple. It helped online businesses accept electronic payments. Back then, buying something on the internet was still new for many people. Many banks were slow to support online payments. Wirecard saw an opportunity. Instead of competing directly with banks, it became the company that connected online merchants. As online shopping slowly grew, so did Wirecard. At first, it looked like a smart business with a bright future. During the early 2000s, the internet changed rapidly, where people started shopping online. Businesses needed secure ways to accept digital payments. Wirecard expanded quickly. The company worked with online retailers, travel companies, and digital services across Europe. Its revenue continued to grow. Investors became more interested. Every successful year made Wirecard look stronger. From the outside, it appeared to be exactly what Europe needed. A fast-growing technology company competing in a world dominated by American firms, the future looked promising. Then, in 2002, everything changed. Wirecard merged with a publicly listed company called Infogene Europe AG. This move gave Wirecard something extremely valuable. It became a publicly traded company without going through a traditional initial public offering, or IPO. Now anyone could buy its shares on the stock market. As more investors discovered the company, its ambitions became much bigger. Wirecard no longer wanted to be just another payment processor. It wanted to become one of the world's leading financial technology companies. That ambition would shape every major decision the board made over the next 2 decades. As the company expanded, it also entered industries that many traditional banks preferred to avoid. These included online gambling and adult entertainment businesses. Many banks considered these customers too risky. Wirecard saw them differently. Where other companies saw a risk, Wirecard saw opportunity. The strategy helped the company grow faster than many competitors, but it also made the business more complicated. Payments moved through different countries, different partners, different companies. And over time, the complexity made it much harder for outsiders to understand exactly how Wirecard was making so much money. As Wirecard continued to grow, one man became the face of the company. His name was Markus Braun. Born in Austria and trained as a computer scientist, Braun believed that digital payments would change the global economy. In 2002, he joined Wirecard as chief executive officer. Unlike many CEOs who stayed in the background, Brown became the company's biggest believer. He often appeared in public wearing his trademark black turtleneck, a look that reminded many people of Apple's Steve Jobs. His message was simple: the future would be digital, and Wirecard would help build it. Brown wasn't just leading the company, he was also one of its biggest shareholders. As Wirecard's share price climbed, his personal wealth grew with it. Investors loved seeing a CEO whose own money was tied to the company's success. It gave them confidence. If Marcus Brown believed in Wirecard, why shouldn't everyone else? At conferences and investor meetings, Brown spoke about innovation, technology, and global expansion. His vision was ambitious. Wirecard would become much more than a payment company. It would become a global financial technology leader. To achieve that vision, Wirecard expanded far beyond Germany. The company bought businesses in Asia, the Middle East, and other parts of Europe. Every acquisition seemed to prove that Wirecard was becoming stronger. Every new announcement pushed the company higher. Investors weren't just buying a payment company anymore. They were buying a story. A story that Europe had finally produced a technology company capable of competing with the biggest names in the world. And as long as the company kept growing, very few people questioned whether that story matched reality. But there was another powerful figure inside Wirecard. Unlike Marcus Brown, he rarely stood in the spotlight. His name was Jan Marsalek. As chief operating officer, Marsalek managed much of the company's day-to-day operations and international business. He was known for being intelligent, confident, and highly secretive. While Brown focused on investors and public appearances, Marsalek worked behind the scenes. Over time, he became one of the most influential people inside the company. Together, Brown and Marsalek appeared unstoppable. One inspired confidence. The other managed the company's growing global operations. For investors, it looked like the perfect leadership team. But behind the scenes, the first serious cracks were already beginning to appear. By the late 2000s, Wirecard looked like one of Europe's biggest success stories. Revenue kept growing. The company's share price reached new highs. Investors were optimistic. But outside the boardroom, a few people had started asking uncomfortable questions. Some investors noticed that Wirecard's financial reports were becoming increasingly difficult to understand. The company often described complex business partnerships spread across different countries. These businesses were said to generate a large share of Wirecard's profits, but verifying those claims wasn't easy. The structure had become so complicated that even experienced analysts struggled to follow the money. Then came another problem. For years, Wirecard claimed that its business came from what it called third-party acquiring partners. In countries where Wirecard did not have the required licenses, other companies processed payments on its behalf. Wirecard said these partners generated billions of euros in payment volume, and according to the company, they also produced its profits. On paper, the explanation sounded reasonable, but proving how much business these partners were generating was much harder. That would later become one of the biggest questions in the scandal. Not everyone believed Wirecard's story. Over the years, several journalists and independent investors raised concerns about the company's accounting and overseas operations. Each time, Wirecard strongly denied the allegations. The company insisted that its financial statements were accurate. Its executives argued that critics were trying to damage the business. Many investors accepted those explanations. After all, the numbers looked impressive. The company continued growing, and its share price kept rising. For most people, success seemed like proof that everything was working exactly as it should. Inside the boardroom, confidence remained high. Every successful quarter made it easier to dismiss criticism. Every increase in the share price made the company look more credible. Instead of slowing down to answer difficult questions, Wirecard continued expanding. The board believed the company's future was brighter than ever. But outside Germany, a small group of reporters had quietly begun collecting evidence. And they weren't planning to give up until they found the truth. In most corporate scandals, the first warning comes from inside the company. Wirecard was different. Some of the biggest warnings came from outside. Over the years, several investors and researchers questioned the company's numbers, but one newspaper would eventually change everything: the Financial Times. Its journalists started looking closely at Wirecard's business. The deeper they investigated, the more questions they found. This wasn't just another story about a fast-growing technology company. Something didn't add up. One of the journalists leading the investigation was Don McCrum. spent years examining Wirecard's financial statements, company records, and overseas operations. Again and again, his reporting raised serious concerns. Were some of Wirecard's profits real? Were important business partners exactly what the company claimed? Could investors actually verify the numbers being reported? Instead of welcoming these questions, Wirecard pushed back. The company strongly denied the allegations. It said the reports were misleading, and many investors believed Wirecard instead of the journalists. After all, the company's share price was still climbing. The situation became even more unusual. Instead of focusing on the questions raised by journalists, German authorities began investigating possible market manipulation. Some believed investors betting against Wirecard stock were trying to push the price lower. In 2019, Germany's financial regulator BaFin even introduced a temporary ban on short selling. It was an extraordinary decision. Rather than increasing pressure on the company, the attention shifted towards some of its critics. For many investors, this looked like proof that Wirecard had done nothing wrong. The company's reputation appeared stronger than ever. But inside the Financial Times newsroom, the investigation didn't stop. Every new document, every new source, every new interview raised even more questions. The reporters believed they were uncovering one of Europe's biggest corporate scandals. Wirecard believed it was defending its reputation. Soon, those two completely different stories would collide. The evidence would become impossible to ignore. By early 2020, Wirecard was under more pressure than ever before. For years, the company had dismissed criticism. It had defended its financial reports. It had challenged journalists. It had continued telling investors that everything was under control. But this time felt different. The questions were no longer coming from only reporters or short sellers. Large investors wanted answers. Banks wanted reassurance. The company's own credibility was beginning to weaken. The board could no longer rely on simple denials. Something had to change. To restore confidence, Wirecard made an important decision. The company hired KPMG, one of the world's largest accounting firms, to carry out an independent special audit. This was different from Wirecard's regular annual audit. The goal was simple: review the allegations that had been raised over the years, check the available evidence, and give investors a clear answer. If Wirecard had done nothing wrong, an independent review could end the controversy. For many shareholders, this was exactly what they had been waiting for. Months later, KPMG released its report. It did not say that Wirecard had committed fraud, but it also did not give the company the clean result many investors expected. Instead, KPMG said it could not verify important parts of Wirecard's business because it had not received enough supporting evidence. Some documents were missing. Some information could not be independently confirmed. For investors, that was a serious warning. Not because KPMG had proven fraud, but because it could not prove that parts of the company's own story were true. For the first time, confidence began to crack. Even after the KPMG report, Wirecard's leadership remained confident. The company told investors that the missing information would be provided. It insisted that its financial statements were accurate. Its annual audit was still being completed by Ernst & Young, better known as I, the company's longtime external auditor. The board believed that once I signed the accounts, the crisis would finally be over. Instead, the biggest shock in Wirecard's history was only weeks away. On June 18, 2020, everything changed. Wirecard released a short statement to the stock market. First glance, it looked like another routine company announcement. But hidden inside was a sentence that would destroy the company. Wirecard said its auditor, EY, could not confirm the existence of 1.9 billion euros. That money was supposed to be held in trust accounts at 2 banks in the Philippines. That amount represented about a quarter of the company's total reported assets. Without it, Wirecard's financial position looked completely different. The announcement stunned investors across the world. Almost immediately, people started asking the same question: where was the money? Wirecard had previously said the cash was being held in trust accounts by partner banks in the Philippines. But the 2 banks named by the company said something unexpected. According to the banks, the documents presented to support those balances were not genuine. They said the accounts described by Wirecard did not exist. The money that investors had believed was safely sitting in those accounts could not be found. The market reacted immediately. Wirecard's share price collapsed. Billions of euros in market value disappeared within hours. Investors who had trusted the company for years watched their investments lose value almost overnight. Banks became nervous. Business partners wanted answers. The company that had once been celebrated as Germany's biggest fintech success story was now fighting for survival. Everything happened with incredible speed. Years of growth were destroyed in days. Only one day later, Wirecard's chief executive officer, Markus Braun, resigned. For years, he had been the face of the company. Now, he stepped down as the crisis grew worse. But his resignation didn't stop the collapse. The missing 1.9 billion euros was only the beginning. Investigators were now asking a much bigger question. If that money never existed, how much of Wirecard's success had been real? After Markus Braun resigned, events moved faster than anyone expected. On June 22, 2020, German prosecutors arrested Braun. He was accused of helping present a false picture of Wirecard's financial health. Braun denied the allegations. The investigation was only beginning. But there was another executive everyone wanted to question. Chief Operating Officer Jan Marsalek. Unlike Braun, Marsalek was nowhere to be found. Before investigators could question him, Jan Marsalek disappeared. According to investigators, he left Germany shortly after being dismissed from Wirecard. At first, many believed he would soon return. Over the following months, reports suggested he had traveled through several countries using different routes. Years later, German authorities continue searching for him. He remains one of Europe's most wanted fugitives. His disappearance only made the mystery even bigger. What did Marsalek know? And why did he leave so quickly? Then came the final blow. On June 25, 2020, Wirecard filed for insolvency. It became the first company ever to enter Germany's prestigious DAX stock index, and later filed for insolvency while still a member. The collapse was historic. Thousands of employees faced an uncertain future. Investors lost billions. One of Germany's greatest corporate success stories had come to an end. But even after Wirecard collapsed, the biggest question remained unanswered. How could a public company worth more than 24 billion euro report billions of euros that apparently did not exist without anyone stopping it? The answer wasn't hidden inside one bank account. It was hidden inside years of decisions made by executives, proved inside boardrooms, and overlooked by people who were supposed to protect investors. Those decisions would soon reshape corporate regulation across Germany, leave lasting questions about the role of auditors, regulators, and corporate oversight. When people first heard about Wirecard, many believed it was a story about one missing bank account. It wasn't. The 1.9 billion euros was only the final piece of a much larger puzzle. The real story had been unfolding for years. It was a story of warning signs that were ignored, questions that went unanswered, and decisions made inside boardrooms that slowly pushed the company toward disaster. Wirecard did not collapse because of one mistake. It collapsed because one risky decision was followed by another, again and again and again. One of the biggest decisions was choosing growth over transparency. As Wirecard expanded across different countries, its business became more complicated. Instead of simplifying that structure, the company continued adding more subsidiaries, more partners, and more layers. For investors, understanding exactly where profits were coming from became increasingly difficult. Complexity isn't always a sign of fraud. Many global companies have complicated structures. But complexity also makes it harder to detect problems. And at Wirecard, that complexity became one of its greatest weaknesses. Another decision was how the company responded to criticism. Instead of treating difficult questions as an opportunity to improve trust, Wirecard often denied the allegations and defended its business. Executives repeatedly said the company's financial statements were correct. For years, many investors accepted those explanations. After all, revenue was growing. The share price was rising, and Wirecard remained one of Germany's most valuable companies. Success made it easier for many people to believe the company, even when important questions remained unanswered. Looking back today, Wirecard teaches an important lesson. Strong growth does not replace strong governance. A rising share price does not guarantee that a business is healthy, and trust should never replace verification. Because once the facts finally emerged, it wasn't only Wirecard that suffered. Scandals shook confidence in auditors, regulators, corporate oversight, and Germany's financial system itself. The company was gone. The questions it left behind would change corporate Europe for years to come. Wirecard's collapse did not end when the company filed for insolvency. In many ways, that moment was only the beginning of a massive legal reckoning. German prosecutors launched one of the country's largest corporate fraud investigations, determined to uncover the truth behind the missing billions. Thousands of documents were collected from offices across the globe. Forensic accountants spent years tracing a digital paper trail that led nowhere. Executives were questioned in high-stakes interviews, while former employees stepped forward as witnesses to describe a culture of secrecy and deception. The investigation worked to understand how a company once worth 24 billion euros could fail so completely and so suddenly, beyond the courtroom. The scandal forced Germany to examine its entire financial system and the regulators who were supposed to protect it. Politicians asked difficult questions. How had regulators missed so many warning signs? Why weren't earlier concerns investigated more aggressively? Could stronger oversight have prevented the collapse? The government responded with major reforms to ensure such a disaster would not happen again. Financial supervision was strengthened, and audit rules became much stricter. The goal was to rebuild trust in the integrity of German markets. For investors worldwide, Wirecard became a permanent warning. It served as a reminder that fast growth can sometimes hide deep structural flaws. New technology can certainly change industries, but it should never replace the fundamental principle of verifying the facts before investing. Every successful company must be able to explain where its money comes from. If a business model is too complicated, that is a red flag. Complexity should raise questions, not blind confidence. Wirecard proved that impressive numbers mean very little if they cannot be independently verified. The story of Wirecard wasn't just about missing money or an executive who vanished into thin air. It was about the danger of misplaced trust. It showed what happens when rapid growth is valued more than careful verification, and when difficult questions are treated as attacks rather than warnings. When confidence inside the boardroom becomes stronger than accountability, the foundation of the entire company begins to crumble. For years, Wirecard convinced the world it was building the future of finance. In the end, its greatest product wasn't technology. It was a grand illusion, a house of cards that eventually fell, leaving behind a legacy of lessons for the global financial world. Corporate scandals are often remembered by one number. Enron had billions in hidden debt. Lehman Brothers had repoed 105. Wirecard had 1.9 billion euro that auditors could not verify. But numbers don't make decisions. People do. Every major corporate collapse begins with choices. Some seem small at first. Ignore one warning, delay one investigation, accept one explanation without enough evidence. Over time, those small decisions begin to shape the future of an entire company. By the time the consequences become visible, it is often too late to stop them. Wirecard also changed the way many people viewed corporate success. For years, people measured the company by its share price, its market value, its rapid growth, its place in Germany's DAX index. But none of those things proved the business was healthy. Growth can hide problems. Popularity can hide problems. Even billion-dollar valuations can hide problems. Real strength comes from transparency, because if investors cannot understand where profits come from, eventually, neither can the market. Today, Wirecard is no longer remembered as Germany's fintech champion. It is remembered as one of the biggest corporate frauds in European history. Its collapse damaged investors. Employees lost their jobs. Trust in regulators and auditors was shaken. And one of its top executives remains missing. The company's offices are quiet, its shares are worthless. Success story has become a case study taught in business schools around the world. Not because of how it grew, but because of how it collapsed. Every company begins with an idea, but every empire is ultimately shaped by the decisions made behind closed boardroom doors. Some decisions build history, others destroy it. Wirecard is one reminder that trust must always be earned and constantly verified. If you enjoyed this documentary and want to explore more of the boardroom decisions that changed some of the world's biggest companies forever, subscribe to Boardroom Files, because the next corporate empire is already waiting.